Welcome back, everyone, to Mike on Money. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us here again this week. Remember, Tuesdays are live, so today we're doing a live market update, and we're going to talk about investing using the 16-40 rule. So some people call that balanced portfolios, where you have a fixed mix between fixed income and equities. We're going to talk a little bit about that. What's good, what's bad, and kind of what we're seeing out there. I've done a couple other deep dive videos to the 60-40 rule. You can find it at our channel at mikeonmoney.com. And of course, as always, if you have any questions, reach out to us and we're happy to answer those. Before we dive into things, of course, as always, keep in mind, this is for information purposes only. Always do your own due diligence or reach out to a professional advisor like ourselves. Happy to see if any of these strategies or any of these portfolio techniques apply to your situation or are right for your particular strategy that you're trying to implement. So reach out to us. Again, you can go to mikeonmoney.com. And of course, that applies if you're watching us live here. By all means, ask your questions today. We'll try to get to them before the end. If you are watching on the replay or the podcast, just go to our website and we'll happily answer all those questions for you. So with that, let's start off things as we do every week. At some point, we might not have to have this at the beginning of all our webinars, but a COVID update. Of course, in Canada here, things in general, despite being pockets and there's still challenges out there, in general, things in Canada are doing quite well, with probably the biggest exception being Alberta. New numbers out this morning around the number of hospitalizations. Just taxing the hospitals right now and the medical professionals. They're at the brink of collapse, I guess, or a failure as far as their medical system goes right now. So a lot of challenges in Alberta. And I know they've even started moving some patients to Ontario, where there's a little bit more capacity right now. We're going to have to see how that unfolds. Overall, as mentioned, across Canada, still doing fairly well. Here in BC, the numbers are still a little bit higher than they'd like per capita, but still within manageable ranges. They just rolled out, I believe it was yesterday, children in school with mask mandates from kindergarten through grade 12. Kind of funny they didn't kind of start with that, but anyway, they've put that into place to just slow down anything within the schools, because of course the major outbreaks here in Canada, or the higher number, is centered around younger people, because those are the ones that haven't been vaccinated to highest percentage as the older population, as they were first in line to get it. And so that's moving along. And of course, some provinces of Canada are also starting to introduce that booster or the third vaccine for those who are immune compromised. And I know Ontario, New Brunswick, and I believe BC is moving in that direction. So, again, we talked about in previous weeks, the idea of an annual booster shouldn't be a surprise or shock. Very similar to that flu vaccine that we have to get every year. So keep the numbers in check and keep things under control, and to prevent. The big thing is to prevent that the mutation, right? New variants, from new stronger variants that might be ineffective with the vaccines. So that's what we're really trying to achieve. Of course, around the world, we're still seeing numbers all over the place. The US is still pretty high. Again, more pockets in the US. They have started to introduce more restrictions like we've seen here in Canada, meaning indoor masks. And certainly we're seeing a lot more venues and states requiring the vaccines to go back to work. New York's got a big one coming up here this week, where they're introducing a vaccine for healthcare workers that have to have it, or they go on unpaid leave. And that's going to be a big test, because there's already a shortage of healthcare workers. So what is that going to mean? So New York's the first state to, basically say, have it or you're out. But there are more and more states are starting to introduce the vaccine mandates and venue mandates, right? So if you want to go to a concert, you want to go to a movie, you want to go almost anywhere, you need to show proof that vaccine passport. So more and more of that's going through. We're still seeing protests around the concept of vaccine passport, and some confusion. As every province seems to be rolling out their own version and their own way to apply it. I think there's still a little bit of confusion out there on that. But things are still going well, so let's keep a watch on what's going on there. So let's jump into the economy. In the US, we are looking for the home price index coming out for July, and the consumer confidence index for September. So just keeping an eye on those, especially with the surge in home prices that we've seen. As that continues, it's flattening. We've seen a lot of flattening in most areas in Canada. There's still pockets of price growth around the home prices. And so we're going to see if we see that down in the US. And of course, the consumer confidence numbers for September. And those should be really good. Early expectations for those are people are fairly bullish as far as the general economy goes. Government bond yields kind of hit their highest level in the last 3 months. So if you didn't watch last week's video, go back and watch that. We talked about stagflation and reflation. And this is exactly what we're talking about. We are expecting that surge before we see that leveling off as the supply chain comes back into kind of refills, or I guess, or get caught up a bit. And where we saw most of the sell-off, and certainly there's a big sell-off today, is around those tech stocks. Again, for the last several months now, we've talked about 2021 being that shift away from the tech sector, those growth sectors, and moving more towards the value. And we're really starting to see that now. That doesn't mean there's not going to be growth or there's not good tech companies out there. It just simply means that the bulk of the returns that we're going to see in 2021 are not going to be driven by those sectors. That was 2020's story for sure, but in 2021, we're starting to see that level off a bit. Those growth numbers got a little bit ahead of themselves, and we're seeing more and more movement into value. The Fed chair is going to speak to the Senate this week as well, just talk about the economic recovery plan. Other highlights, hedge funds, score taper trade hat trick. Basically, what we're seeing is the hedge funds who sold the treasury positions, for much cheaper prices, and on the yield curve as it flattens out, are starting to make money on that. We are seeing more money being made in the tactical fixed income, and we're going to talk a bit about that when we talk about the 60-40 rule at the end here. And it's important to make sure that in this stagflation, reflation market, long bonds are not going to be your friend. They're not going to help your portfolios. You're going to have to be a lot more tactical. And we're going to talk a little bit about the hedge fund strategies, and of course, we're going to talk about tactical strategies as well. Electric supercars need to lose some weight, power up and cool down. Obviously, this is the the race out there for supercars and cars in general to go electric. Before climate policy starts to cut their combustion engines use, and we're seeing this a lot of race teams. If you're a race car fan. In any of the circuits, a lot of them are moving to, or at least build and research around electric vehicles. And we're going to talk about an IPO today called Polestar, which is an electric vehicle manufacturer. Actually the vehicle itself, or the technology development, came from the Volvo race team. So we're seeing a lot more of that coming to market as well. Oil prices are climbing with a little help of those hedge funds as they make bet on the oil demand. And we're going to dive a bit more, so I'm not going to spend a lot of time on that right now. We'll talk a little bit more about energy and oil prices for the next couple months as well. The U.S. Senate Democrats brace for a loss in the showdown over the vote on the debt ceiling, and that's where we're seeing the volatility today. And of course, that happened last night. Is the Republicans voted down raising the debt ceiling, so the ability of the U.S. government to borrow more money, and of course that means they can't pay their bills. I believe the date that they run out is October 18th. This is not the first time the Senate has pushed back against the debt ceiling in order to negotiate over other issues. And obviously the Republicans have a lot of issues with the Biden administration, whether it be their social agendas or the Green New Deal or the infrastructure package that's up for vote as well. So pretty much what we're seeing is a negotiation tactic, a little bit of probably overreaction in the market today, as some concerns over this kind of bottleneck in the Senate, which don't be surprised, the Senate seems to be bottlenecking on almost every issue that goes through there these days. Strong U.S. business spending on equipment has seen as the big part of their GDP growth for Q3, and this goes to a lot of automation, upgrades to plants, new computers and electronics. This is the kind of back to work economy. Everything from office, office space to manufacturing has had to deal with employment shortages, first of all. So, more automation, so they need fewer people, but also spacing people more, which means using more technology, using more, automated technology. A lot of companies have gone to a hybrid called hoteling, where some employees work at home part-time, they're in the office part-time, they don't have a permanent desk at home, but they've had to set them up at home with computers and electronics to be able to connect into the corporate systems, and of course all the that hardware all has to be secured for cybersecurity. So a lot of spending on that front has occurred, and that's driving quite a bit of Q3. And we've also seen, the big area of this lack of employment is in the service industry, or the lower pay and hourly work. And if you've been into any fast food restaurant these days, well, any restaurant really, you've seen the effects of those shortages. A lot of your favorite restaurants are probably not open as much, or they shorten the menus because they just can't get the staff to be open all the time, or offer the diversity of services. But we've also seen on the fast food front, which generally are minimum wage jobs, switch into more automated tellers or automated order systems, not only because wage pressure is going up, but also they just can't find people. So there's a lot of spending on those fronts. On the Fed side, the bond tapering still hinges over continued job growth. And this is back to the inflation story. So how quickly are they looking at tapering? What's that going to look? And it's really teeter-tottering between the employment report and of course economic growth. Those are the two factors that are going to affect how quickly they do that. They don't want to stifle growth, and they want to make sure that the employment numbers stay strong as well. Global oil demand is reaching the pre-pandemic levels, should be there by early 2022. So that's why we're seeing the hedge funds lean a little bit into that sector. I mentioned over the last couple of weeks, definitely energy does well in an inflationary market. But the bigger thing that we're seeing that's underpinning a bit of this, if I've done some deep dives into oils. If you want to go look at my longer term projections on kind of oil demand, it is global oil demand is decreasing over time as we switch to new technologies. But the key thing to keep in mind through that process, and that's definitely what we're seeing right now, is the switch from renewables from oil doesn't happen, or from fossil fuels doesn't happen overnight. Whether it be solar or wind or any of these other technologies, it takes time to get that capacity in place, and it will take time. It will take the better part of 10 years to certainly get to a massive tipping point. So, energy or fossil fuels as a sector is not going away. And we're seeing a lot of challenges where governments are, of course, and corporations, like we talked about last week, BP making a massive shift to renewable, kind of moving away from investment in the energy or the fossil fuel side of things. But that's leaving a bit of a gap on the supply side of things. And it will continue. So there will still be demand. We will still see that increase in pricing, maybe even more than we normally would have on the energy side, as the world is trying to catch up with renewables. So we'll keep a close eye on that. But certainly 2021, as I mentioned, is our forecast is energy should do well. EV makers, I mentioned earlier, Polestar is striking a $20 billion deal. To use a SPAC, again, a SPAC, Special Purpose Acquisition Corporation. We did a deep dive on that one as well. By all means, go in and watch that if you're curious. They're raising $20 billion to go public. Is that a good valuation? This goes back to my EV story or electric vehicle story. I'm not super keen on the manufacturers. Tesla, of course, being probably the most popular one out there. Not to say they're not going to go up, not to say there's not growth stories, and not to say that they're not going to do well. My big concern around them is the valuations are really, really high. We're seeing massive new competition coming into the market as far as EV makers go. My preference is to play the supply chain side of things, so all the parts and components that go into these things, because then you don't have to pick which manufacturer is the winner. They're all going to have to buy these supplies, and they're all going to have to buy the parts. And I think that's the better side of things. So Polestar, is the valuation 20 billion low? It's probably going to go up because there's a lot of hype around that market right now. Certainly a lot of interest. It should do well, but my general preference is to focus on the supply chain over the manufacturers. I did test drive a Polestar, by the way. Nice vehicle, not overly impressed, but nice vehicle. Kind of costly actually for what you get. Sorry, let's dive into the U.S. The Conference Board. I mentioned the Consumer Price Index. The Consumer Confidence Index is expected to rise for September, so we'll keep a really close eye on that. Again, we're probably going to see that bullish into the Christmas season or into the end of the year. I mentioned that the Fed Reserve is going to be talking at the Senate. Micron Technology is expected to report a rise in fourth quarter earnings based on that chip shortage. So again, pretty much any chip manufacturer is going to be doing well in the next quarter. There's a chip shortage for everything from phones to vehicles. Everything has a microchip in it these days, probably your toaster. So there's just a huge demand around that that was caused by that supply chain shutdown. Facebook has put the Instagram for Kids on hold amid criticism. Who could have seen that one coming? Basically, if you haven't followed this story, Facebook was looking to introduce a different version of Instagram, so the social media Instagram. They want to come out with a version for kids 13 and under, because the current Instagram is designed or supposed to be only for kids 13 and above, or people 13 and above. And they got a lot of backlash, because of course, social media, the concern around social media that teenagers and people in general, already face a lot of bullying and problems around being online. Facebook's argument was the kids are already online. We should try to make the environment safer for them by coming out with a version for them. So there is something to that argument. The big challenge is how do you do that, because they can't do it with their current offering with Instagram. So really, what are they able to put into place to be more protection for the kids? And of course, there's bad actors out there who would want to harm kids and try to take advantage of those platforms. So that's been shelved for a while. They said it's not off, it's not gone permanently, but they decided to shelve the idea for a while, maybe while they try to figure out what that would look like and communicate it better to the marketplace before they move ahead. Google's in a big fight in the EU over a record-setting fine that they got of 4.3 billion euros, kind of blaming the regulators for ignoring Apple and other big tech companies. This goes back to this global tech fight that we're seeing. The big, huge companies, kind of the antitrust fights, basically saying that Google is using unfair business practices and related to their Android operating system, which is why they're saying, well, look at Apple, they're even worse than we are. They should have a big fine too. So they're fighting that fine. It will probably come down in appeal. It is a pretty big record-setting number and not likely to stand where it is right now. But this antitrust theme that we're seeing in courts, we talked about a couple of weeks ago, we talked about in the US, there's a big new antitrust laws coming out and antitrust court cases by the Fed in the US, but also by the states, targeting almost all the big companies, Amazon, Google, Apple, Microsoft, all equally. Wells Fargo, this is an ongoing case we've talked about. They agreed to settle the class action lawsuit over overcharged customers in the tune of $37 million. And this goes years back when they were opening accounts for people who didn't even ask for them and just started charging them. But the employees and management were all getting bonused off of, the massive number of new accounts that they were open, trying to make their financials look better. So they're settling a lawsuit there to kind of put it behind them. It's been going on for quite some time. I think it goes all the way back to, memory serves me, somewhere around 2017 or maybe 2016. So it goes back quite a ways, and it's just kind of the final payouts, hopefully, to put it behind them as well. Pfizer's beginning a study of an oral drug to prevent COVID-19. So instead of a vaccine, an oral solution, early stages. I wouldn't get too excited yet. Hopefully, there is some advancement on that front, and that they can move forward with that. But also, Pfizer also announced this week that they're moving forward with mRNA for the flu vaccine. So they're taking that technology, which has been around for a long time. In fact, I was reading some research. It goes all the way back to '72 when they started work on this. I think there's a really good documentary about it. So it wasn't something that just came out for COVID. But the reason why it was faster for COVID is because all that research was focused around that COVID strain, SARS, flu, and of course COVID-19, which are all in kind of the same viral family. And that's how they were able to get it out for COVID-19 as quickly as they did. So now they're taking what they did there and looking at the yearly flu virus and seeing if they can apply that as effectively. So that might be good, as it's shown to be one of the more effective vaccines that we have available out for COVID right now. Apple's new iPhone is going to take longer to get customers. So if you order the new iPhone 13, surprise, surprise, the supply chain is being taxed. Harder for them to get manufacturing and get it out. Not really the chip supply in this scenario, just because Apple switched to building all their own chips. It's just their manufacturers are just busy making all kinds of products, and they just can't keep up with the demand. So if you were hoping to get an iPhone 13 sooner than later, you might have to wait a little bit. On the Canadian front, Canada's looking to lure US frequent flyers to Air Canada, or Air Canada's looking to lure the US frequent flyers by kind of offering perks to Americans who have qualified for US airline frequent flyer levels. So WestJet's done this in the past for many Air Canada flyers. They would offer them gold status if you had higher status at Air Canada as kind of a freebie to kind of encourage them to go over. So Air Canada is doing that with different American airlines. So if you fly a lot with not American Airlines, which is an airline, but airlines who are based in the US, and you have status with those airlines, you might be able to get that matched by Air Canada, just trying to lure you onto their flights. So we'll see how they do. Obviously, there's a big battle for passengers these days, with still the travel reopening being a bit slow. Canada's clean energy lobby groups call for changes to the draft in the clean fuel standard. Sorry about that. Obviously, a flagship piece of the climate regulation here in Canada has been our clean fuel standard. And with our recent election and Trudeau going into his third term, I know, I don't think he's finished one completely without calling an early election yet, though. But the industry is now pushing him to come up with something more targeted to achieve that net zero emissions. And that goes back to what I was talking about earlier. Great goal. I don't think anyone would argue against the goal. It's like, how quickly can we do it? Because it's not always just about commitment, or even in some cases money. It takes time to get to switch over, because building those cleaner fuels, or those renewable fuels, take time, and it's not it's not a 6-month process, it's years. So we'll see. At some point the regulation is going to have to face reality of what that looks like, and the lobbyists, of course, are pushing for sooner than later. But there is a fight between time and an ability to wean off the fossil fuels to get to a net zero. China says Canada should draw lessons from the Huawei exec case. So if you didn't follow the Huawei chief CFO Meng Wanzhou, who was on house arrest here in Vancouver since 2018, I believe, over espionage charges in the U.S. So she was being extradited, or the U.S. was trying to extradite her to the U.S. to face charges. She struck a deal, or Huawei struck a deal with the U.S. She paid a fine, and they dropped. She pled guilty, paid a fine, and the charges went away. And Canada, therefore, she doesn't need to be extradited. So Canada released her. So she's headed back to China, and almost immediately, the two Michaels, the Canadians who were being held, I think their prison sentence was set for 11 years on espionage over there, were released and sent home, which is great news for them. China says that they sent them home for health reasons. The U.S. is saying they were sent home because Biden made a phone call to China and said, you have to do this, and we'll strike a deal. Who knows what happens? I'm sure the families around the two Michaels are extremely happy to have them home. And where Canada goes with China from here, as far as trade negotiations and obviously relationships, we'll have to keep a close eye on. So we talked about Evergrande last week. So Evergrande is the big capital investment company in China, mostly real estate, that basically went into foreclosure. They were on the verge of bankruptcy. Lots of people losing money, a lot of lenders losing money in the tunes of billions. And at the last moment, and we saw markets dip there for a day where no one knew what was going to happen or who was affected, who held all the debt. Basically, it was pretty spread out globally, but not to the tune that any one company, in my opinion, I don't think any one company was, going to be devastated by it. Not like 2008 financial crisis, but certainly no one wanted to see that happen. So the Chinese government did backstop them at the last minute. So now it's kind of the battle of what to do with that debt. Blue Bay, which is part of Royal Bank Asset Management, is out there. BlackRock is out there, accumulating some of that credit exposure on the bet or the gamble that China is going to continue to back it, and it's going to have a sharp turnaround or give them a better return. While we have other companies out there like HSBC and TCW basically closing out the positions. They're selling out. They just don't want any exposure to it. They're moving on. So I still think it's a pretty big gamble at this point. China, while they have stopped in to back them to some extent at this point, whether they're going to 100% back them, whether they're going to let some of the credit default, it's completely, everything's on the table at this point. China doesn't have a big history like the US or Canada to backstop the too big to fail kind of companies, they might very well let parts of it default on some of the loans. So we'll keep a close eye on what's going on there. On the US dollar front, we did see it rise, of course, as always, when we see weakness in the market, which of course we're seeing today. We saw the treasury yield, head higher. Of course, the dollar got a bit stronger. So it doesn't really change our outlook or trend. As the markets continue to perform, we will see the general trend down on the US dollar. But look for, anytime there's volatility, look for strength in the US dollar. And we talked about bonds kind of hitting their high. On the oil front, we talked about that. It's moving its way quickly to the $80 barrel range. Again, going back from May 2020 when we hit minus $34 a barrel just for one day, but it did hit there. We've come a long way, and that only looks like it's improving for all the reasons we've discussed. Natural gas is also kind of jumping almost 6%. As more and more people start turning up their furnaces as we hit into the colder weather. That's pretty standard for the season. Metal prices edge a little bit lower based on the Fed Reserve going to talk to the Senate about their economic recovery plan. And 3-month copper prices dropped just slightly, not much, still holding in there very, very strong. Same with gold, slight drop as well. So let's take a look at the 60-40 environment, what that looks like, and what we should expect in portfolios. So if you just to give you the theme again, if you're really interested in kind of my thoughts and a deep dive into 60-40, and that's basically 60 equity, 40% fixed income bonds or anything else that be considered fixed income. Go watch that video. You can go to mikeonmoney.com and go to our YouTube channel, and you'll see it there. But we do a deep dive into it. But just for today, I'm going to cover kind of some of the key points around the 60-40. So as we shift into this mid-cycle expansion, we have a high level of unusually higher levels of uncertainty. So that's the volatility we're seeing, right? Any kind of spark will move the markets temporarily up or down. And with the inflation numbers, of course, we have the debt ceiling today affecting the markets. A week or so ago, we had the Evergrande thing affecting the market. So any of these aspects are going to introduce volatility into the portfolio. Now, that's not a bad thing. Remember, volatility is your friend because, especially if you're longer term investing, because it allows you to buy at cheaper valuations or better valuations. So don't be afraid of volatility, but we definitely are going into this volatile period. We're moving away from this peak growth, where 2020, where we saw the fall at the beginning of the pandemic, and then kind of the steady record markets every day as we saw steady growth happening. We're moving away from that growth. Again, that goes to the value theme that we've been talking about. The Delta variant's still out there. We still have the bottlenecks in the supply chain. That's going to continue to be a challenge for those markets. And just as growth is slowing, we're looking at tapering, liquidity in the market, in interest rates. So that's a fine line that we've been, covering for a while. You don't want to raise rates to stifle growth. You want to raise them enough to slow inflation, but you don't want to stifle that growth. So we're in that fine tightrope walk as far as those rates go versus economic growth, and that's going to be a tough line to watch. So how does that translate into the 60-40 rule? Well, the big challenge is whenever you see volatility, correlations tend to move to be positive. And what correlations are, this in a very brief sense, most people equate it to, stocks go up, bonds go down, bonds go up, stocks go down. It's not how it works. Correlation can be 1-to-1, meaning they move in unison, they all go up or they all go down together, or they can be a fraction, right? It could be a 0.7 correlated. So you move up slightly, but not as fast as the other one, but you don't move down as fast as the other one. So correlation is anywhere from 0 to 1. And it's across not just asset classes like bonds and stocks, but it's between countries, it's between sectors, it's even between local geographies, meaning like within Canada. So we track all kinds of correlations between all these different factors. And what happens when we go into volatile periods is they positively correlate. So the 60-40 premise, the efficient frontier or modern portfolio theory, which is all based on basically saying, if your optimum blend is 40% bonds, 60% stocks, and if stocks go down, your 40% bonds will protect you, and if stocks are going up and your bonds are underperforming, don't worry, the 6% stocks will outperform. So that's the concept behind it. But that positive correlation that we now see, and we've been seeing for the better part of 10 years, even the creator of modern portfolio theory, the Harvard professor Markowitz, has come out and said his theory no longer works because of these positive correlations we see in the market. So it becomes challenging to stick to that. And that's where a tactical approach becomes vital in a portfolio. And that's the ability to move away from those positive correlations when the risk starts getting higher and move into areas that are of the markets or geography or sectors that are not, that are behaving the way they're supposed to, right? So they're not being affected by whatever the underlying situation is. So that doesn't mean you sell out everything and go into the one thing. That just means overweighting and moving your portfolios away from certain areas of risk during those periods of time. So, as I mentioned, long government bonds, not a great area to be looking at in this. So there are alternatives out there. I talked about tactical bonds, which we definitely have in the portfolios. There's inflation protected bonds, which we have in the portfolios. There's different areas you can look at to, again, still find those returns, but move away from some of the riskier volatility. So you want to gain exposure and growth, from those risky assets, but you want to be cautious. You want to be able to dampen that volatility, and you want to find sources for your portfolio to mitigate risk. So defining a good strategy, well, equities, your basic sources are equities, fixed income, and alternatives. Alternatives being more kind of the hedge or private side of things. Equities, we want to tilt to those quality value stocks, particularly long-term growth themes. The ones with solid growing cash flow. Can't stress that enough. Cash is always king. That's where you want to look. Fixed income, be defensive, right? Look for strategies that are sought with maybe a little bit more credit risk, but a lot shorter, right? Stay away from the longer ones. Try to get the yields where you can, but a lot of due diligence goes into those higher yield curves because you don't want to get caught in a default situation. Alternatives investors can look at hedge funds who apply a lot of these strategies. They use arbitrage strategies, long short equities, or even long short credit strategies, event-driven strategies, turnaround stories, and sometimes a distressed or special situation. And you're seeing Royal Bank, we mentioned earlier, Royal Bank, taking some risk and looking at Evergrande debt, hoping for a strong turnaround there to get higher than market yields. So, it's not a 60-40 passive approach in this current market. Have to be a bit more active, and you definitely want to do a lot of due diligence in the different areas you're looking at. So, where can you find those? I mentioned the quality and the long positions. Fixed income, really the tactical approach is the way to go, and the long shorts and the hedge are kind of the stronger areas you want to take a look at. Really, the message here is that 60-40, don't get stuck in that fixed income equity portion. We talked last week, definitely your equities should be a little bit more tilted to global these days. Yes, the US has had a great run, but they tend to be that growth story. There's a lot more value outside of the US. And there's more asset classes than just equity and fixed income. Really look at those alternatives and those niche areas of growth that you can take advantage of in a portfolio that will really or non-correlate and outperform the underlying marketplace. You don't necessarily want to be index-based. You really want to find the diamonds in the rough in those portfolios. And you might forego a little bit of positive returns in the short term in order to position yourself for a lot lower volatility. Because really remember, when in a volatile market, one of the more important strategies is to avoid too much of the pullback. Because if you have $1 million invested and it goes down 20% to 800,000, and then the markets go back up 20%, remember, you're not at break even, because your 800,000 going up 20% doesn't get you back to $1 million. So if the market falls 20 and your portfolio only falls 5, and the market goes back up 20, and even if you only catch half of that, 10%, you're still in a better financial position than if you went for the full ride. So that's where the tactical really comes into play. Be smart. Reach out to us if you want to look at your portfolio, to discuss, what's happening in there tactically, or if you want us to review an external portfolio outside of Canaccord to see what's in there and what might be at risk, or what might you really want to look deeper into going forward. So with that, that's all I have for this week. I know it was a longer one. Really appreciate your patience. Remember, go to Mike on Money, give us your comments, reach out to us. Also, any ideas for our deep dive videos that you want to see or hear about, happy to dive into those and give you some more updates. But with that, I'll let you go enjoy your day. Thanks very much for joining us. Take care, everyone. Bye for now.